Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is May 11, 2026, Weekly Market Insights with your host, Brent Foster, in the Northbound Wealth Podcast. Stocks rise with upbeat news. So, stocks rose last week as peace talks picked up while investors cheered better than expected economic news and Q1 corporate results. The Standard & Poor's 500 index advanced 2.33% to another round of new highs as the technology sector climbed on deals and earnings. The S&P 500 ended Friday's session at 7,398.93, marking its latest all-time closing high. The market benchmark also set a fresh intraday high on Friday at 7,401.50, its sixth consecutive week of gains. The index is up about 8.1% for the year, while the Nasdaq Composite Index rose 4.51%, closing Friday's session at 26,247.08. Dow Jones Industrial Average edged up 0.22%, closing Friday's session at 49,609.16. We're looking for it to hit that 50,000 mark again, as it did in February. The MSCI EFA Index, which tracks developed overseas stock markets, added 1.24%. Again, sixth straight week of gains. This week's advance came as deal chatter and better than expected earnings drove strong gains in the tech sector. The deals included a preliminary agreement under which Intel will make some of the chips powering Apple devices, according to a Wall Street Journal report citing people familiar with the matter. Just so you know, that's a step away from TSMC, which is probably smart and wise over the long term. Also, payroll data from the Bureau of Labor Statistics showed the U.S. economy adding more jobs than projected in April. This helped allay concerns about a slowdown in the labor market. Investors also saw the data as likely allowing the Federal Reserve to stick to its current policy stance. Non-farm payrolls for April rose by 115,000, well above the 65,000 increase expected in a Bloomberg-compiled survey. Private payrolls growth slowed to 123,000 in April from 190,000 the prior month, the BLS reported, surpassing the consensus estimate for a 75,000 gain. The unemployment rate was unchanged at 4.3% in April, in line with Wall Street's estimates. The technology sector jumped 7% on the week, followed by a 1.9% increase in communication services and a 1.8% increase in consumer discretionary. Materials, industrials, and real estate also edged higher. Akemi Technologies and Datadog topped the technology sector as shares soared 42% each. Akemi's Q1 results included a slight earnings beat, and Chief Executive Tom Leighton said that U.S.-based frontier model provider has committed $1.8 billion over 7 years for the company's cloud infrastructure services. A Bloomberg report cited people familiar with the matter said the partner is Amazon.com-backed artificial intelligence startup Anthropic. Datadog's surge came as the software maker posted higher than expected Q1 results and raised its full-year outlook. Walt Disney's stock was the best performer in communication services, climbing 4.8% on the week as the media and entertainment company's fiscal second quarter results came in ahead of market estimates. Amid revenue gains across all business operations, Disney also reiterated expectations for growth to accelerate in the second half. Tesla led the gainers in consumer discretionary. The electric vehicle maker's shares rose 9.6% amid a report that the company's China-made electric vehicle sales rose for a sixth consecutive month on a year-over-year basis. On the downside, the energy sector fell 5.4%, followed by a 4% loss in utilities, a 1.4% slip in financials, and a 1.2% decline in healthcare. Consumer staples were also lower. The drop in energy sector came as crude oil futures also fell on the week. APA was hit the hardest in the sector, losing 11%, despite the company's Q1 earnings coming in above analyst mean estimates. In utilities, energy shares had the largest percentage drop for the week, falling 10%. The company reported Q1 adjusted earnings per share below analyst mean estimate, even as revenue topped the street's view. So, weekly market insights, major index return summary. Let's see. The year-to-date numbers for the S&P 500 is up between 7.5% and 8%. The Nasdaq is up around 11 to 12%. Dow Jones up about 3 to 4%. 10-year Treasury rate 4.38%. That's up 2.1% since about a month ago, which it closed at 4.29. So you see the 10-year Treasury note climbing a little bit over the last 1 month, 3 month, and year trailing numbers about flat to where it was about a year ago. 4.37 was the print 1 year trailing, and now it's 4.38%. So we'll keep an eye on that. It'll affect mortgage rates to some degree and decision making about asset allocation. So again, let's review the jobs report surprise. Employers added around 115,000 jobs in April versus the 55,000 economists expected. Jobs grew the most in healthcare. So those entering the workforce, take a look at that. Retail is the second, and leisure and hospitality sectors. It's another good sign. Unemployment held steady at about 4.3% last month. And other economic news, new home sales data released last week showed sales for both February and March exceeded expectations. That's a good sign. In March, 682,000 newly construction homes were sold, up 7.4% over the prior month, while February new home sales jumped 8.9% over February. So the housing market seems to be moving a bit here. Okay, so we're going to be tracking that. All right. Key economic data, Monday, existing home sales. The NFIB Small Business Optimism Index is Tuesday, along with Consumer Price Index and some Fed heads speaking. Wednesday, Producer Price Index, and Thursday, Retail Sales Weekly, Jobless Claims and Import Price Index, Business Inventories, and then other Fed heads are talking. Friday, Industrial Production, Capacity Utilization, and the Home Builder Confidence Index. I'm going to be paying attention to that one to see where this data continues to trend and if that's going to be a theme for this year. We'll see. Hopefully, interest rates can come down, so mortgage rates come down, but we'll see what happens. All right, so notable companies reporting earnings this week: Constellation Energy, which is today, Wednesday, Cisco System, Thursday, Applied Materials, which is AMAT, ticker symbol. We got Brookfield Corporation is also reporting this week. So not a ton going on this week as far as earnings reports. All right, tax tip of the week. The IRS has made it easier for you to file your taxes. Forms now include electronic signature options, allowing tax professionals to conduct remote transactions. To allow your tax professional to use the electronic signature option, you must fill out and submit a Form 2848, Power of Attorney and Declaration of Representative. This form constitutes a written authorization appointing tax professionals to represent taxpayers before the IRS, including performing certain acts on the taxpayer's behalf. These acts may include providing electronic signature, and this information is not a substitute for individualized tax advice. Please consult with a qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. All right, stay tuned. We got a good show for you. Hey, in this segment, we're going to talk about some Did You Know? So 2 out of every 3 S&P 500 companies mentioned AI on their fourth quarter earnings calls. And that's not a trend, it's a signal. The last time a technology shifted this many boardroom conversations at once, when do you think that was? That's when smartphones came around. And we know how that turned out. Some sectors are all in, others are barely speaking the word AI. That gap between the early movers and the quiet ones, it matters for investors. So we're going to be paying attention to this AI theme. And we seen this before as the technological revolution continues. So again, more than 65% of S&P 500 companies talked about AI on fourth quarter earnings calls. In other news, happy National Golf Day to everyone who loves the game, and to everyone who loves someone who loves the game. Your patience is appreciated. Golf and financial strategies actually have a lot in common. Both reward patience over impulse. It's really hard to hit those straight, true shots, isn't it? Unlike me, I tend to be out in the woods somewhere. Both can punish you for trying to do too much. I'm guilty of that. Grip and rip. That's what I say. And that doesn't always work in golf. It works in baseball, though. The people who stay calm and manage the course usually come out ahead. Now, if only we could remember that somewhere between the first tee and the 18th green. So enjoy the golf season as the weather has shifted and is warming up. And if you're not out playing golf, what about your pets at home, given that this is National Pet Month, May 2026? Who else has a pet that runs the household? Whether it's a dog, a cat, or something with scales or feathers, pets have a way of taking over. They love us unconditionally. They give us so much joy. They're a big part of the fabric of our families. They also can cost more than we expected, require more preparation than we anticipated, and somehow we'd do it all over again in a heartbeat. If you have one or three or had one in the past, then you know. And in our family, we have a pet beta fish called America. He's been with us for over a year now. It's been wonderful to have him. He just floats and swims around, eats, and we take care of his tank. It's a great pet for my young family. All right. Let's see. In other news, most parents think the last tuition check means game over for college and kids being on payroll. The data says it's about halftime, so don't get too excited. 50% of parents with adult children still provide regular financial support, spending $1,474 a month to do so. That's more than twice what they're putting towards their own retirement. Here's what, quote, just helping out a little, end quote, actually looks like. So 75% of parents aged 45 or over are financially supporting at least one adult child, even though over half of those children can meet their own basic needs, according to a 2025 AARP survey. 42% of supporting parents report financial stress. 9% have retired early because of it. 47% say they've sacrificed their own financial position for the sake of their kids. 18% say the support could continue indefinitely. They don't see an end in sight. This isn't about being less generous. It's about being intentional. Whether your kid is just graduated 5 years ago, or is still in school, the question is the same. Is your support happening by design or by default? That's worth a conversation. And then in May, if you don't already know, is 529 month, give it an acute reference to May 29th, which is coming up. According to a Fidelity article for the 2025-2026 school year, the average published all-in cost at a 4-year public school for out-of-state students is $45,780. And the average private school costs about $60,920 a year. So because this is, I call it 529 month, it's a good time to revisit one of the most flexible tools for tackling those numbers, what 529 plans actually do. Here's a review. Tax-free growth and tax-free withdrawals for qualified education expenses. State tax treatment will vary, and so will fees and expenses. Use them for college, trade school, K through 12 tuition, and apprenticeships. A 529 can even repay up to $10,000 in student loans. Whether a 529 qualifies for a state tax deduction will depend on your state of residence, as state laws and treatment may vary from federal tax laws. Superfund, up to $95,000 in a single year by using 5 years of gift tax exclusions at once. But remember, if you make non-qualified distributions, earnings will be subject to income tax and a 10% federal tax penalty. Minimal impact on financial aid. Parent-owned 529s are assessed at a maximum rate of 5.6%. Grandparents, parents, aunts, or uncles can contribute. And starting in 2026, the K through 12 annual withdrawal limit doubles to $20,000. The best time to start was years ago. The second best time is now, so they say. All right, stay tuned for the next segment. And on the retirement front, think you have to start claiming Social Security at age 62? That's a myth that could cost you. Fidelity recently broke down this common misconception with the facts behind Social Security. Here's a summary of them. Claiming at 62 locks in a permanent 30% reduction compared to waiting until full retirement age. So the actuaries kind of penalize you for taking it early. Waiting from 62 to age 70 can increase your monthly benefit by approximately 77%. If you're divorced after 10 or more years of marriage and haven't remarried, you may be entitled to 50% of your ex-spouse's benefit, and claiming it doesn't affect theirs at all. Benefits are based on your highest 35 years of earnings, not just what you made before age 65. Working past 65 can still improve your calculation. Once you claim it, that's your benefit, adjusted only for cost of living increases or COLA increases. The decision of when to claim is one of the most consequential decisions when preparing for retirement. For a benefit designed to last 20 years, 30 years, or more years than that, the math is worth getting it right and having a review. If you have questions about Social Security and taking that, give us a call at Northbound Wealth Management, 317-399-1107. We'd be happy to review your situation with you. But also talking to the Social Security office is probably your primary focus too, is to make sure you get the accurate data for your specific situation. All right, stay tuned for the next segment. The retirement conversation most couples keep putting off. For many of our clients, years of focused preparation and disciplined strategy have been aimed at a single goal: arriving at retirement in a position to live the life they envisioned. The investment accounts, the income strategy, and all the other considerations, all of it was built towards that moment. And when the moment arrives, the financial side may be largely in order. What is sometimes less thought through is the life side of it, where they will actually be, how their days may look, what each person is genuinely looking forward to, whether the two of them have been picturing the same retirement at all. Research suggests that many have not. Fidelity's 2024 Couples and Money Study tested 1,794 couples by surveying each partner separately. What it found was striking. 53% of pre-retired couples disagree on how much they need to save for retirement. 48% disagree on when they intend to retire. 45% argue about money at least occasionally, yet most believe they communicate well. The gaps are the kinds of misalignments that may surface at an unexpected moment, sometimes after one partner has already made a major decision that the other was not expecting. It's a timing problem. Nearly 2/3 of working couples expect to retire at the same time or within a year of each other. According to Ameriprise Financial's 2024 Couples, Money, and Retirement Study, only 11% actually do that. More than 62% end up retiring more than a year apart, even when that was never the goal. When it happens by surprise rather than by design, the household dynamic can shift in many ways couples are not prepared for. The retired partner may lose professional identity and daily structure. The still working partner may come home to a different kind of pressure. Neither tends to show up in a financial strategy. The conversation's worth having now, you guys. Retirement preparation tends to be thorough on the financial side and thinner on everything else. These are 6 questions that can reveal meaningful gaps in retirement expectations. Number 1, where will we live, and have we both truly agreed? This is often the question with the largest financial consequences and the longest lead time. Cost of living, proximity to family, and what to do with the primary residence may all depend on having a real answer, not an assumed one. Number 2, What does each person need to feel purposeful? Retirement removes the structure many people have organized their lives around for decades. Couples who navigate this transition more smoothly tend to be the ones who have thought about what may replace work, not just financially, but personally. Board service, consulting, a creative practice, a physical commitment, a volunteer role. For many people, these are closely tied to identity. Number 3, how will healthcare costs actually land? So, a 65-year-old retiring today can expect to spend approximately $172,500 on healthcare over the course of retirement. For a couple, that figure is roughly $345,000. These estimates cover Medicare premiums and out-of-pocket costs, but do not include long-term care. Medicare is also more complex than many people anticipate, with income-based surcharges, potential coverage gaps for couples with an age difference, and meaningful trade-offs between premium cost and provider access that may differ for each partner. Number 4, what if one person needs extended care? According to the U.S. Department of Health and Human Services, 56% of adults turning 65 between 2021 and 2025 are expected to need some form of long-term services and support. Okay, that's 56%. Research from Morningstar found that a couple facing those expenses may see their wealth decrease by an average of 21% over 9 years. The options available at 70 are often more limited and more costly than those available earlier in the process, like age 60. So, number 5, how will Social Security be coordinated for both partners? Claiming strategy, and that's the process by which you actually make the claims and the timing of that, is among the more consequential decisions couples make, and that benefits, one that benefits from an advanced framework. So lead time. The timing of one partner's claim can affect the survivor benefit available to the other partner. While benefits may begin as early as age 62, delaying to age 70 raises the monthly benefit to its maximum. In 2026, the difference between claiming at age 62 versus 70 is more than $2,200 per month. And that's a meaningful number for a lot of folks. But you got to assess your health in that process, and longevity in your family and medical history, things like that. Number 6, is there a formal strategy or just assumptions? Among couples with at least $100,000 in investable assets and within 10 years of retirement, Ameriprise's 2024 research found that 41% have no formal financial strategy, 39% have no retirement income strategy, and 52% have no estate strategy. These are not couples who lack resources. They are couples who may not have yet had the full conversation. Retirement is more than a finish line. The financial side of retirement matters enormously, but couples who tend to feel more settled in retirement are often the ones who have also worked through the harder questions. What their days may actually look like, whether their individual visions align, and what they may do when the unexpected happens. Those conversations are worth having well before the date on the calendar arrives. If any of this raises questions, we're here to talk them through with you, if you'd like, at Northbound Wealth Management. Anyway, hope you found this information helpful. And for that, have a great week and weekend. We'll talk to you next week. Thanks for tuning in. Like and subscribe.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.